as I always say during these webinars, if you are an advisor and you're in an office, do me a favor, tell other fellow advisors that this webinar is taking place. Hopefully we'll get a good crowd here. It's going to be interesting conversation around China and how to think about next year and what we've seen this year. For those that are here for the CE credits, I will email you afterwards to get your information to submit that to the CFP board. Just stick to the end of the presentation. If you have any questions, folks, during this webinar, just put in the Q&A. We'll try and break it up towards the end here. And hopefully all of you will enjoy this. So, with all that said, my name is Michael Gayed. This webinar is sponsored by KraneShares. This is Mr. Henry Greene, who I think is going to teach you guys a lot about China here. So I'll hand it to Henry, and looking forward to this conversation.
Hi, thank you for joining us. As Michael said, I'm Henry Greene. I'm a senior strategist here at KraneShares, and it's my pleasure to be presenting to you today. Today, what I want to do, what Michael and I talked about doing, is giving a quick update about some of the interesting developments we're seeing in China as of this latest quarter, and then getting into our very unique covered call strategy, which uses our flagship KWEB China Internet ETF as the underlying. So just a quick introduction to KraneShares in case you're not familiar with us. Our founder and CEO, Jonathan Qwen, started and sold a successful media entertainment business in China in the early 2000s, came back to the United States, saw that what people were investing in when it came to China was not where the growth was. He said people need more exposure to technology. He said technology is going to be number one in China. Growth stocks are going to be the most important theme. And so he said, why don't we create exchange-traded products to capture these themes? Fast forward to today, we are a much larger firm with a much larger suite of products, mostly ETFs, capturing broader emerging markets, alternatives, as well as carbon credits. China in Q3. All right. So what happened recently? We had Trump and Xi. They finally met. Now, for a while, that was a little bit uncertain whether or not the meeting was actually going to take place. We had Trump, I think when he came into office initially, he said, it'll be within the first 100 days. And then that kept getting pushed back and pushed back and pushed back. And then obviously you had the Liberation Day tariffs, claiming very, very high, the highest we'd ever seen, claiming that, those would be the tariffs would be reciprocal, would be put on China. Obviously this caused a great deal of volatility in markets. Fast forward to today, we had kind of ratcheting up in pressure right before this meeting, which is kind of expected. That's Trump's style. And then we had this meeting, which resulted in a lowering of tariffs. Now, there are many tariffs, but overall, it's down to about 10% on China, and about vice versa, either way you go. And also an understanding around rare earths, where China's issuing export licenses for rare earths to the United States. And then in reciprocation, the United States will allow more chips to go into China. Now, these are temporary. This preliminary agreement is supposed to last for a year. But we think that this is the start of something really fundamental, really, really good for the U.S.-China relationship, something that we've been waiting on for a long time. I would argue since 2016, 2017, when Trump kicked off the trade war with China. So this is a really good thing for the world and the world economy. And we don't think that it's actually been correctly priced in yet by markets. So we think there's more upside from these trade deal. People say it was underwhelming. We actually think that given that this is the best development that we've had in the past, 7-8 years. So so China really came on the scene this year in terms of AI technology. No one really thought that China could innovate in this space like we do here in the United States. That preconception was, in our opinion, completely destroyed by the release of DeepSeek in China, a large language model that was shown to perform just as well, if not better, than ChatGPT in the United States. So we've seen this theme continue to cause a re-rating in China technology, which has been very positive for the markets we invest in, especially KWEB. Now, there are some very key and very interesting differences now that we are seeing emerge. And I think we saw emerge, especially this year, in this past quarter, even between China and the United States when it comes to artificial intelligence technology. And with that, also robotics has become a key theme. And so these are so what are they? I mean, so number one is the models themselves that are being released, the large language models being released in China are mostly open source. Okay. And that's very different from here in the United States. We prefer closed loop, these private LLMs where, if you want to use it, you have to pay a licensing fee. And then even that, you don't control your own data. When you're using, whether you're using Grok, we use Grok, or you're using, ChatGPT or what have you, whatever model you're using, usually you have to sign over that data to that model. Whereas in China, they're mostly open source, where you can say, okay, I can take the model, from Alibaba's Qwen or take the model from DeepSeek and actually just take that model and make it my own and use it for my own purposes. So that's a really key difference. And so the monetization in China is coming from the cloud more than selling LLMs. Okay, difference number two is who's leading the charge in AI development. It's in China, it's actually mostly the largest publicly traded internet companies. Okay, this is a key difference as well, right? Alibaba's Qwen is the number one, maybe number two, most used large language model. It's one of the most popular, and it's run by Alibaba, which is a key holding in KWEB and a publicly traded stock, right? In the US, it's mostly led by private companies, OpenAI, of course, being the best example. And then on robotics, right, which is kind of now this new offshoot we've seen of the artificial intelligence industry, China, they're really good at making the hardware for this. They've come a long way in this. As you see on the screen here, to my right, this is actually our team went to Beijing earlier this year, and was getting coffee served to them by a robot right in the middle of Beijing. Okay, this is not happening here in the United States. But what is happening here in the US that we do very well is we do still have the cutting edge in terms of the chips that are going to be used to actually control some, the actual robotics physical infrastructure, right? So quote unquote, the brain, right? That's something that we do very well here. So we see the future of robotics as being perhaps Chinese technology and in the US, certainly US made software. And obviously that can help with, security concerns, et cetera. And then finally, of course, the multiple in China is much lower. KWEB, we see a PE of 18 compared to something like NVIDIA, which trades at 58 times earnings, right? So we still think there's room to go, even though, as we can see here, right, KWEB, representative of the China internet space, has done very well so far this year. So this is from the end of 2023. So just showing you kind of how KWEB has reacted to different events. KWEB does very well, but it's still, the average multiple is still a lot lower, 30, 40, 50% lower than take any average, whether it's NASDAQ 100 or one of the internet indexes in the United States. You're going to usually find a lower multiple in China. That's still the case despite this strong performance. Okay. So, dovetailing into our conversation, what I'd like to speak about, our product that I'd like to bring up today, which is KLIP, which is, selling covered calls on KWEB. So if you look at KWEB here, right, you see that it's very reactive to these kind of global, policy and economic events. So China stimulus is the classic example. Last year in September, they announced unprecedented measures, multiple ministries announcing huge measures to stabilize stock market, buy stocks. This is akin to, we had the China's national team, which are investment funds associated with sovereign wealth, buying stocks, which we related to, something the Japanese central bank has been doing for a long time, which is buying stocks. So anyway, that caused a huge surge in KWEB, which was followed by, obviously, markets got over-exuberant and came back down. And then they hit another kind of low point in Liberation Day with the tariff announcements, right? But then when we realized that a lot of those were going to be exempted, that, they were going to kind of kick the can down the road on those, with hopes that there would be some kind of deal. we saw markets come back leading up to, around today. I think this chart is as of the 5th, where we have a meeting between Trump and President Xi. So KWEB, I think there's two things to remember about KWEB. Number one, it represents what we think is the cutting edge of technology, especially artificial intelligence in China, insofar as you can access it within the public markets, but it's actually very accessible in the public markets through KWEB. And number two, even though the fundamentals of these companies, Alibaba, Baidu, are not really affected by these big geopolitical and trade events, nonetheless, KWEB is very much affected by these geopolitical and trade events, making it very volatile. Okay. And a volatile, relatively representative of a dynamic market investment is apt for a covered call strategy. Okay. So for those of you who are not familiar with a covered call strategy, right, basically you're taking advantage of the volatility in the underlying, whether it's a stock or an index or an ETF. In this case, it's an ETF. You're taking advantage of that volatility by just kind of selling calls, basically literally selling calls at the money and taking that premium for people who want to buy those calls. And obviously you're selling that call. You're not selling a naked call. You're selling what's called a covered call because you own the underlying. So we actually own KWEB within KLIP and then sell calls that are covered, hence covered calls by our holdings in KWEB. So I would imagine that a lot of you are familiar with covered call ETFs. They've become actually quite popular in recent years in the United States. We're showing basically growth in options-based ETFs, many of which are covered calls, though not all of them are. Right. So there are now over 200 available. I mean, it's probably 300 now. I mean, these things it seems like there's a new one that comes out every day. And then the assets have grown to about $30 billion in covered call ETFs. And it's quite amazing. I like to mention to people, so a lot of people don't know this, there are actually now more ETFs than stocks listed in the United States, right? Which is a pretty incredible statistic. And I think a lot of that is from these options-based strategies because these include things like single stock levered ETFs, right? Of which we do have a handful. And of course, covered calls being a large category. So why are we able to do this? And more saliently, why are we able to do this so efficiently? Okay. The reason is KWEB is just a liquidity machine. Okay. KWEB has the second largest options market. So that's the sum of puts and calls, the notional value. The second largest in China ETFs, fourth in emerging markets, third in what we define as thematics, and then 13th as of when this data was taken, which was October 13th, 13th in the U.S. out of all U.S. listed ETFs. So that means there's always a market for these calls, right? And it makes strategy very efficient, and makes it very liquid. KLIP itself is very liquid. The calls are very liquid, right? So that just kind of creates this very good environment to launch a covered call strategy on KWEB. So just breaking down really quickly for the dynamics of what's actually going on here, right? And how to think about it. So with KWEB, again, I showed the chart earlier. You're getting uncertain downside and uncertain upside, right? Just like any stock. With KWEB can see pretty significant drawdowns that we've seen over the past few years, right? So that downside is significant, more significant than if you're investing in the US, okay? But the upside is also significant, right? If people say no risk, no reward, so there's also an incredible upside and a good story to tell. And like I said, the valuations are low, so KWEB could continue to just go on up. So with KLIP, you're basically exchanging the uncertain downside and uncertain upside by writing a call for option income and uncertain downside. Okay. So you're basically exchanging the upside of KWEB, for a monthly income stream, that is relatively attractive. And we'll get into that in a minute. So I implied this, a little bit, just before, but, KWEB is a great deal more volatile than, major US equity indexes. So here we're looking at NASDAQ 100, Russell 2000, S&P 500. NASDAQ 100 and Russell 2000 are right neck and neck in terms of vol. And then KWEB, you just see kind of blows them out of the water. And, it's come down recently just because the KWEB's performed well, better, in 2025. The volatility definitely reached its peak around 2023. And that's, coincidentally when we actually launched this strategy. Okay. So we really saw an opportunity here to take advantage of that, incredible volatility. Not only is KWEB volatile, it's also relatively uncorrelated, has a low correlation with global equity markets. So again, looking at the same Russell 2000, NASDAQ 100, you look at a correlation of 0.41 or lower to these markets, which is difficult to get in a lot of places, and certainly difficult to get in something as liquid and dynamic as of an investment as KWEB, we think. So that's certainly makes holding KWEB itself valuable from a risk return perspective. But also it makes KLIP's income stream and return stream all the more attractive because of that. If these are the other markets that you have in your portfolio, right, KLIP can provide this kind of little bit of an income buffer, as well as this kind of uncorrelated, low correlated return, which can be very valuable in an overall portfolio. So yeah, as I said, the reason, KLIP is able to give these high income distributions from the sale of its options is because of this implied volatility being much higher than these other markets, right? And so just to put this in perspective for you, on the right, we see we have S&P, NASDAQ, Russell kind of providing monthly income. And this is assuming you're just selling kind of at the money calls, using either Black-Scholes pricing formula, right? So a lot of assumptions here, but basically if you did this strategy on any one of those three, you would likely be getting a monthly income, in the 1.5 to 2.5% range. With KWEB, it's twice that. So, nearly 5%. And then, so with KLIP, you're going to get, like I said, so remember, you're exchanging the upside of KWEB, for uncertain downside plus income. Okay. But really what that creates is kind of a much smoother ride, with KLIP, in terms of the NAV, right? So the highest single day was about 5%, 10% per KWEB. Lowest one day return, similar kind of ratio here. So you are getting a bit of a smoother ride with KLIP in terms of just the pure NAV. One of the ways that we've seen clients use KLIP is to complement their existing exposure to KWEB or to China more broadly. And so with KWEB, basically the way you can think about this is with KWEB, you're getting 100% exposure to this growth sector, the China internet sector, 100% downside, 100% of the upside, right? And then with KLIP, you're exchanging that upside for the option income, okay? And you could kind of barbell this if you wanted to, right? And really bring down your overall China internet allocation or your China allocation. You can really bring down the volatility in that allocation. You can increase the income you're getting out of that allocation, right, by barbelling it between KWEB and KLIP, or even KLIP and another China strategy if you're choosing, right? And so we think this is really powerful. It's a way that we've seen a lot of our clients work with KLIP. And the best part is you're still getting that growth exposure in the 50% to KWEB and also through KLIP, right? KLIP still benefits when KWEB goes up, right? So you're not losing that, right? And so that's just what's kind of really powerful about KLIP. So this is just recent distributions. So one of the things I do want to say about our distributions and where we stand, because I know I mentioned before, right? You can get an income level. So again, this is monthly. This isn't an annual yield. So the annual distribution rate is 25%. This is looking at, so the percentage I'm referring to is actually the monthly income. So you can actually generate 5% a month by doing this. And for a while, we had uncapped distributions. So recently, at the beginning of this year, 2025, we decided to cap our distributions at 2%. And the reasoning for this was to avoid what's called NAV erosion, where basically if you hadn't been reinvesting, your distributions come in the form of a dividend from the ETF, right? You would have had just the NAV consistently declining, right? And you would have lost that reinvestment into the strategy, right? Which we think is very important. So we decided to cap distributions at 2%. Initially, we had a mixed reaction to this, but it's overall, we believe it's improved the experience of our clients. And we've had a lot of people say, that this is much more preferable, that now they can kind of understand the strategy a little bit better. And they get some of that income because people weren't reinvesting. A lot of people wanted to use KLIP for income. And so now you get that reinvestment into the strategy built in there, between the differential between the two, cap and, what in recent months has been about 5% in terms of income generation. Yeah, so that's KLIP. I don't know, Michael, do you have any initial thoughts, or I don't know if we're getting any questions or...
Yeah, I'll take a look at Q&A. As far as what you see from advisors, if they want to mix the two ETFs, what kind of allocations do you typically see?
In terms of, we like to look at it and say, okay, 50-50 as a baseline. But we've seen people do many different things. We've seen people do kind of more KLIP than KWEB too, people who maybe, I think it depends on what your relationship with KWEB has been previously, whether you're a long-term holder, right, and you want to kind of maybe take some gains and move it into something that's a little bit more, a little bit less volatile, get a little bit more of that income generation there. We've seen that be a popular option as well. So I think it depends on your needs and your relationship with KWEB, if there was one previously.
It's a good question from Brian here. How much upside are you trading away with the call sales?
It's a lot of it. KLIP is gonna, KWEB is up 30% this year, for example. And KLIP is about flat year to date. So, and KWEB is up 30%. So you are exchanging a great deal of that upside. KLIP would benefit from, the best environment for KLIP is probably the one we've had this year, or one where KWEB is a little bit maybe not so bullish, but just kind of steadily inches along. But you are exchanging that upside. No, sorry, the NAV of KLIP is flat, is what I meant to say, but the total return will be higher because if you're reinvesting those dividends distributions that you're getting from KLIP, if you're reinvesting those, you are getting a significant return, right? So let's see, we don't actually have year to date here, but 6 months. So this is total return. You have 13% for KLIP and 20% for KWEB. That's as of 9/30. So it is a significant amount of the upside you're exchanging. But again, because we cap the 2% as well, KLIP should see a little bit more NAV appreciation than the past strategy.
Let's talk about the tax treatment of those distribution rates. Is it ordinary income? Are you doing something else there?
It's ordinary income. Yeah. It's funny because, we actually, sometimes it'll show up in our 19As as return of capital just because it lowers the basis. But from a tax perspective, it's ordinary income. We don't give tax advice, so I'd recommend somebody speak with your tax professional, but, that's ordinary taxable, income. Yeah. There's not really a tax, advantage.
Do you find that these type of strategies more resonate with retail as opposed to advisors in general?
That's a good question. We have seen interest from both. I think initially, just because of the income level was so high. Again, before we capped the distributions, right, it was 5% and even higher than that monthly, right? So we definitely saw a lot of retail interest from people seeing that just high yield number on the strategy. So these are people who are buying the single stock yielding ETFs, right? That became popular. And so KLIP was kind of getting some interest in that crowd. And then when we capped it at 2%, I think the interest was a little bit more with advisors. Just because they weren't kind of chasing after that yield. They wanted something a little more stable, a little more predictable. I think a lot of our KWEB using advisors were big fans of KLIP. But yeah, it's mixed. It's a mixed interest.
Again, folks, for those that are here for the CE credits, I will email you after this webinar to get your information. Let's talk about the diversification aspects against other options, income strategies. You mentioned, I think, 200 plus that are out there. When you look at correlations, how does that stack up?
KLIP, I would say, is very uncorrelated to most of the either whether it's covered call or the single stock. I mean, if you talk about options related, obviously there's a big universe there, but even just covered call strategies mostly have focused on U.S. markets in this marketplace. And KLIP is just different. KLIP is not going to be the same. KLIP is, like I said, KWEB, the correlation for KWEB is 0.4 or lower. Right. And so with KLIP, you're going to get kind of the same thing, right? When it comes to U.S. markets, KLIP is a higher income level because you have this volatility, just higher volatility, like I said, and very uncorrelated to U.S. markets. We actually did some analysis of the marketplace, and KLIP is, I believe, it's one of only a very few covered call strategies available in the U.S. that actually uses an international market as the underlying. I think it's one of 3, 4, or 5, if that. And so, yeah, it's really unique exposure. If you've been using covered calls, this is certainly going to add to your portfolio and diversify significantly, even within your covered call portfolio if you have one.
Yeah, I think that's a good point. Anything else you want to bring up? Any other suggestions or other funds you want to bring up that might pair well against KLIP?
Yeah, sure. I mean, so as I mentioned, KWEB, but also we have, various China strategies, right? We have KBA in A shares, so that's kind of you're getting a beta there to the A shares. That's the onshore market, right? Which has not seen the same performance this year as the offshore market, and we think that it's due for a little bit of a comeback, which is also thanks to just local dynamics in mainland China, where we see local investors going more into stocks from historically low allocation levels to stocks. And that's a long-term phenomenon. So we think that KBA there could have some upside, right? And then you could also pair that with KLIP, because KLIP, again, like I said, you could pair it with KO, but you could also pair it with any kind of China exposure that you want. And it'll give you a little bit of income protection. Obviously, the underlying is that offshore market, right? So you could also pair it with onshore market for a little more diversification. I think that would be interesting as well. So, and if you're interested in the option space, we've also recently had multiple single stock levered ETFs come out. Obviously, those are we have a lot of retail clients in those, but those are actually on our top names within the KWEB portfolio. So Alibaba, PDD, and we just did JD as well. So those are pretty interesting. And then KMQ, we also have KMQ, which is takes this kind of innovation story, the internet innovation story that we've seen in China and that consumer story, and broadens it out further to encompass all of emerging markets and say, look, we want to have the consumer technology names, we call it emerging markets consumer technology, and stripping out all that old kind of low growth stuff, right? Which is industrials, financials, just stripping that out and just going for we want the consumer, we want the technology. So that's, things like companies like Mercado Libre in Latin America, e-commerce, they've done very well. SEA in Southeast Asia, or C, as I think it's called, they've done very well. So anyway, expanding that KWEB thesis to broader emerging markets through KMQ. That's another strategy that's going to see higher correlation with KWEB. But, if you're more interested in kind of the broader emerging market story, you might want to look at KEMQ for that. And then you could also pair that with KLIP, though, and it would make sense because, again, you got a lot of the KWEB names still in there. So you are going to see this kind of correlation, and then you're going to get also the income as a little bit of a buffer. So yeah, I think those would be the main ones that I would kind of mention in relation to KLIP and China Internet.
That's a good place to wrap up this webinar. Appreciate those that are here. Hopefully you found this interesting. Take a look at KLIP. And Henry, as always, I appreciate your time here.
Yep. Thanks, Michael.
Thank you, everybody. Cheers.
Hey, take it easy. Bye.